Okay, so this is an updated presentation on commercial triple net investing, and I have adapted this presentation to accommodate my own experiences with triple nets. So it's not just a theoretical presentation, but it's also a practical presentation that can be used. Now, pictured here, we have a couple things. Number one is a deal that I'm doing that's a brand new Dunkin' Donuts. The picture below is just for illustrative purposes. The store hasn't opened yet, and our closing is actually timed to the store opening. The second is a Jack in the Box. It's called a Mark 7 version that I own in Baton Rouge, Louisiana with a partner. And the top right one is a Starbucks. That's a nice brick building, also brand new in Virginia. So these are just representative examples of what you can buy with commercial triple net. Many people don't believe that they can own the building, and many people believe that the restaurant business owner actually owns the building. And I'll explain to you during the presentation why they don't own the buildings. There's a standard disclaimer, which basically states that we do not provide tax, accounting, or legal advice, and that the information presented is not considered tax advice. And clients should always review any planned real estate or financial transactions with the appropriate professional. And that my team is licensed in California, and we use cooperative brokers out of state sometimes. Now let's talk about 1031 exchange because this is very important. So when you have a property that's a rental property that you may have not lived in at all, or you may have lived in over 5 years that doesn't qualify for capital gain exclusion, then you're going to want to use a 1031. The 1031 allows you to assign a intermediary party to accommodate the sale, and in essence allows you to replace the asset with a equivalent asset. Now, very broadly, there's people that have sold businesses that have bought real estate. There's people that have sold real estate that have bought life insurance. So there's a very broad definition of like kind, and I always encourage you to check with your tax advisor on the specific business. The typical scenario is rental property. We use 1 to 4 units or a condo, and trading it up into commercial property. So the key things in a nutshell is that you have 45 days to identify the property. Once you've identified the property, then the exchanger must close within 180 days. Once the deal is closed, then pretty much the exchange is considered complete. The expenses are usually about $700, and there's additional wiring fees and so forth of about $200 per side. You can also do creative things such as trade up 2 buildings for 1 commercial property. So this in a nutshell is my experience with multifamily investments. Multifamily investments are a great way to get started in investing, but it's not the end all be all because you come in there with very little down payment. However, there is always a lot of expenses. So if I'm looking here at the windows, I already know by heart that the windows cost $16,000. That's about $300 a window times let's just say 8 windows per side or etc. So it's not cheap, and when the tenant turns over, there's usually management expenses that get involved. So this is our experience with multifamily. We've had, as you can tell, sometimes the rents are below market, like the $1,100 rent, and sometimes they're above, but usually they're below. And if the property manager is not proactive or doesn't change the rents, then you could get stuck in a situation where your building has below market rents. Or typically what I see is someone inherits a property that the rents are super low because the owner says, you know what, I'm not going to pay property manager, I want to save on the fee, and then the tenants, they just don't bother the tenants, either because they grew too close to the tenants or just because of lack of attention on the investment. This is an example of McDonald's. And what's interesting about this one is that McDonald's are rare, and of course they're corporate guaranteed leases, so they don't sell at a high rate. A cap rate is simply the definition of the annual income, and the way that you derive it is you take the annual income divided by the price. So the higher the income is, then the higher the cap rate is, and the higher cap rate is a better return. So when we look at things like McDonald's, we look and see that it's a corporate guaranteed lease, and that it's a long-term renewal, and it's got options, and it's got high traffic count. So based on those factors, the cap rate is low unless you particularly want to have a McDonald's guarantee. And then these are some of the other brands. There's a multitude of other brands that I encounter. I just encountered a Walmart deal. That's $30 million. There's CVS, Burger King, Starbucks, etc. Now here's the cool thing. The tenant pays for the taxes and insurance. So essentially there's no, what you're netting is actually what you're netting. And the leases are guaranteed. If it is like, let's say, Burger King, there's usually going to be an operator, and you want to evaluate whether the operator has strength. So there's also no no expenses essentially on an absolute triple net. So for example, I can show you some examples where things such as landscaping, etc., they don't even get tallied. You don't even get the bill for the real estate taxes. Okay, now this deal is a little bit different. This is the Wells Fargo building I have, which is 2 units. The second unit being in that little area there that's hard to see. And when we bought this deal, our group takes a little bit of risk, but there was only 3 years left on the lease. So what happened was we know that we know that this is the place where people put their money. It's the only bank in a 5-mile radius, but the lease options don't go past it at least has option renewals, but they're at really, really high prices. So long story short, I just renewed this for 5 years with another 5-year option. And the rent that I renewed it at is above market rent, but below the current rent. So I was renewed at $80,000. Now, because it's a 2-unit building, the tenant pays the pro rata share, which means that we take the square footage divided by the total square footage, and we do a proration. So in this particular case, we do get the taxes, and then we basically bill the tenant for their portion of the taxes. The upside of this transaction is that there's an empty unit. So because there's an empty unit, then it's a lot easier. It's a lot of upside to be able to fill that unit. This is what the cash flow looked like when we bought it. So we got it for 1.3 million with 30% down, and we got a 10-year fix, 4.9, which is really hard to get on a lease that's expiring in 3 years. The rental income is $9,000 a month, but you can see what the other side rented. The rental income can be an additional $2,000 or so. You'll notice here that while the other units are vacant, there's a tiny bit of taxes. And again, that's just because Wells Fargo pays their percentage portion of the tax amount. And then the return on investment is dictated here. The total cash flow is $5,000 a month, and that's split with my partners, and it's basically pure income. Now let's say that landscaping gets overgrown. Same thing happens. We basically send that to the tenant to bill, and we bill them for, I believe, 70% of their total space. And they're okay with that. That's already part of their lease. This is the Jack in the Box that I acquired last year, and this is this was built in 1999, and the lease is also extremely high, $217,000. This isn't something for your average client because, as you can tell, the lease is going to be over in June of 2018. Once it's over, then the building could go dark. I am in the process of renewing the tenant, but that is not something that normal clients would want because of the potential risk. Now that being said, this is the specs on it. 2055 square feet, lease expiring in June 2018, and the tenant takes care of all the taxes, insurance, roof, etc. This particular store has good visibility with 50,000 cars per day, but again, it is a little bit risky. This is an example of my proposal. Initially, they proposed 110,000, then they changed their mind, and then they were going 100,000, and they had tried to put down the building. And long story short, they are telling buyers $75,000 to $80,000 to renew, and currently we proposed 88,000, which we feel is a fair, amount, because again the rent is getting $200,000 per year. This is an example of how it displays on the taxes. So in essence, you'll notice that the triple net property, $73,000 comes in. There is legal fees that were on the deal initially, which is the cost of acquiring the property, and I'll go into that later. And in essence, there's no taxes and there is no insurance, And you'll notice that there's no repairs, and that's because it is a triple net property. The simplicity in management is really beautiful. This is why you do it, because the tenants will direct deposit the money into the account. So Wells Fargo is nice enough to give us a summary of the rent and the CAM expenses. The CAM expenses being the taxes and insurance, and then the Wells Fargo goes into the account, and then the Kentucky Fried Chicken that we also have goes into our account. Now, if you are more of a fan of brand new buildings, there's a lot of developments. This particular store is going to be developed, and it's going to be developed in 2 weeks, so November 2017. And you can tell that there's a huge population, and it's actually an out parcel to Home Depot. So it's going to be a new building that looks like this. And this particular store actually has a pretty big franchisee. Basically, the business owners have 50 of these stores, and you can see that it's in a good location, a good shopping center. Now, why do they want to not own the real estate? Well, a lot of them actually have options to purchase the real estate. However, the reason that they don't own it is because these businesses are doing a lot of volume, like $1 million plus in volume. This particular store being new, of course, hasn't been tested yet. But given that there's a lot of businesses nearby, then we anticipate that there will be good sales. In fact, the tenant has signed over a 15-year lease. So that's actually very, very interesting because a 15-year lease is considered really desirable. And if you think about it, if you're buying a new building and the tenant hasn't occupied the space, there's a probability that the tenant is going to renew. And that's basically just because the lease isn't considered used up. There's, good utility. So this is what the deal looks like here. My client is putting down 50% and 103,000 comes in. This doesn't count the 10% increase that's built in. So there's a 10% increase in year 6 and another 10% increase in year 15. That will take it to a whopping $137,000 of triple net income. Very, very nice for $2 million. Now, I just negotiated a better term for the client. So this 25-year went to 30-year, and that increases the cash flow from $2,700 a month to $3,200. Now, in this chart, I'm actually counting principal and interest. So just be aware that most people don't count principal. So I put two numbers here. One is 4,500 and one is 2,700, which includes principal. So just be aware of that. I'm a fan of full disclosure. This is the KFC that I have with partners. This is a nice deal where there's pretty much 10 years left on the lease, and the tenant is doing really well, $1.3 million in sales, and they've got 10 years remaining with 5-year options to extend in a big corridor. It makes $70,000 a year, and the price point is $1.1 million, so not too shabby. And this is also located right outside a Walmart shopping center. Now, so this is typically what happens. Sometimes we take an old apartment building that's very, very high maintenance, and we trade it up into commercial property. The commercial property buildings, like this one, is a refaced Popeyes. That's a new version Taco Bell. So we negotiate the deal. All the work is done up front, and then once the client does their due diligence, then pretty much it's set it and forget a type of income. Now here's the other benefit. The other benefit is that you get to depreciate the property for a longer period of time. So for example, with residential property, the limit is 27.5 years. Well, many people that I encounter have already owned their unit for 27.5 years. The commercial property goes for 39 years. So basically, it allows you to depreciate the expense. Talk to your tax person regarding depreciation because it is a really nice offset. Essentially, you take the income here, you subtract out the virtual depreciation, and voila, you're left with negative income, which then offsets your adjusted gross income. So again, talk to your CPA about it because one of the biggest benefits is the ability to write off the depreciation against the income. This is typically what gets done. This is the deal that's here, and $400,000 comes in, and we take that $400,000, we put into an exchange company, and then we calculate how much the net proceeds are and figure out backwards how much to put down. Now, commercial properties do require 30% down. 35% could be the case if the deal is not that great, but usually the deals that I negotiate have really high cap rates. Century 21 basically has a really nice commercial platform, so that's why I'm with the brand, and it allows us to tap into multiple systems. It's also global. So the second thing is to generate an offer is not that challenging. We prepare an offer letter of intent agreement, and once we prepare the letter of intent, we negotiate the terms. It then takes us a week, maybe 2 weeks, to actually prepare the contract. And this is the case where we cheat a little bit. If the other side has an attorney, we ask them to draft the contract, and then we take our attorney and we look and get feedback. So after the contract is generated, there's different forms that are provided. California deals can be done on California forms, but a lot of times there is an out-of-state form, in which case if there's an out-of-state deal, I will ask you if you want to use an out-of-state attorney or if you want to use my attorney, for example. This is an example of a deal that the attorney did. $2,500 was spent on the contract. And this is basically depending upon if you have questions, if you need clarification, if there's other work involved as well too. So having a good attorney looking at the deal ahead of time will save a lot of grief. Now, after that, the escrow company receives a deposit, just like a residential property, and then they follow the written instructions in the contract. Sometimes there will be a closing attorney for the seller. For example, in New York, we have a deal where there's a closing attorney, and then they agree to use escrow to handle the money. I don't always like to have the seller's attorney handle the escrow funds. Now, you actually apply for a loan technically after you've gotten into contract. This is very different from residential, and then this is typically done within 2 weeks after the offer is signed. The lender will also require information about the property, including pictures, lease information, as well as the financials. Now, corporate leases do not provide store sales, so just keep that in mind. Some deals also, even if it's a franchise tenant, like let's say Taco Bell, they may not want to provide the store sales as well too. Now, the appraisal is ordered. This is ordered out of the deposit to the lender, so it could be $2,500 to $5,000. And if you don't have a copy of the old report, a new phase 1 environmental report is needed. So those are the two things that are very time consuming, and which is why it's hard to close commercial deals unless your closing is in 60 days. Now, of course, the seller is obligated to disclose anything they know about the property. So many times you might be afraid of an as-is sale, but the seller still has to disclose every single thing they know about the property. Then the buyer has the right to do inspections, and the buyer should receive and review reports and disclosures. Now, once all the documents are met, then the buyer's lender will generate the loan documents, which contain the promise to pay. The buyer will then make an appointment to sign, and the documents are usually at the escrow company. Loan funding, basically after the buyer's lender funds the loan, then any remaining conditions get taken care of. Now, of note here is that the insurance also has to be done according to transfer to the name of the landlord, which will be you as the buyer. So this is handled. You do not need, in most cases, a separate insurance policy to purchase the commercial property. Then escrow records the ownership of the title, and then possession of the buyer is delivered. You will not get keys actually because you're pretty much getting the rent. So I'm going to add a note saying direct deposit is set up with a voided check, because that really is how easy that experience is. And that's usually done, by the way, with the lease administrator for the tenant. Now here's a couple more deals to look at. This is a Burger King by a franchisee called Strategic Restaurant Group. The franchisee, if you look them up, is one of the biggest franchisee of Burger Kings, and they've got 15 years left on the lease. So this is what I would consider a good deal with a decent return. The return, I think on this one was about 6%. Here's a deal that I'm buying that's a Pizza Hut in New York, and it's got a high cap rate and a low price point of $700,000. The high cap rate is because there's only 7 years left on the deal. So it's not your deal for everybody, but we are gambling on the fact that the tenant has put in $300,000 worth of improvements in the building. So in essence, because of that, we're gambling that they're going to want to stay, especially given that their lease option renews at a cheaper price than what they're currently paying. So a small deal, but but the return is good. Now this particular franchisee has 280 locations throughout the United States. The LLC that guarantees the lease has 80 locations. That means that if they default, we could go after their LLC, which has a lot of skin in the game. Now this is the return on the deal with 30% down. With 30% down, $43.75 comes in per month, and we have a mortgage. And basically after the mortgage, the cash flow is $2,500 or $1,300 if you count principal and interest. Okay. Eventually the mortgage does get paid off. You can see that this mortgage is amortized over a 20-year period. So it gets paid off pretty fast compared to a single family home. Here's other deals just to look at. This is a corporate guaranteed 7-Eleven with a modest cap of 5.68. So if I'm getting a modest cap, I would expect to get a really good long lease term. And corporate 7-Elevens are really nice because they're also guaranteed by corporate. So in a nutshell, since I'm active in this space, I come across at least 3 deals a day, which I'm organizing, sorting, and researching. So at any time, you can call me and I can tell you what deals I have and what deals that are so good that I would buy it. And I can also tailor it to meet your specific needs.